Slide 1. Advanced Financial Accounting and Reporting. Chapter 3. Hi, my name is Brian. Welcome to Chapter 3, Consolidation of Financial Statements within this Advanced Financial Accounting and Reporting course for BA Economics third-year students. We will explore holding, subsidiary, associate relationships, consolidation objectives, and course structure learning outcomes. Slide 2. Course Agenda. This slide outlines the Chapter 3 agenda. We begin with consolidation concepts, holding, subsidiary, and associate definitions. We explore balance sheet and profit and loss preparation, recognize minority interests, and eliminate intercompany transactions. Finally, we cover goodwill and joint ventures. Slide 3. Holding company. This slide defines a holding company as an entity owning enough voting shares to control another company's board and decisions. Majority ownership grants governance authority, enabling policy oversight. Recognizing this concept is crucial for understanding consolidation principles within corporate groups. Slide 4. Subsidiary company. This slide defines a subsidiary company as an entity controlled by a holding company owning over 50% voting rights. This majority stake mandates consolidation of financial statements, combining assets, liabilities, and income. Consolidation reflects the group as a single economic entity. Slide 5. Associate company. This slide defines an associate company as an entity where another company exercises significant influence without control through 50% voting rights. Under the equity method, the investor's share of profits and losses adjusts the carrying amount on the balance sheet. Slide 6. Control versus significant influence. This slide contrasts control and significant influence. Control grants power to govern financial and operating policies through over 50% voting rights. Significant influence via 50% ownership allows participation in policy decisions. This distinction determines whether consolidation or equity accounting applies. Slide 7. Why do we consolidate financial statements? This slide explains why consolidation is necessary. It portrays the group as a single economic entity, enhancing transparency and preventing off-balance sheet concealment of liabilities. Consolidation ensures comprehensive visibility into collective assets and obligations and reflects economic substance over legal form. Slide 8. Consolidated balance sheet. Basic principles. This slide outlines principles of preparing consolidated balance sheets. It requires line-by-line combination of group assets, liabilities, equity, and income. The parent's investment in the subsidiary is eliminated against subsidiary equity. Minority interest is recognized, and intragroup transactions are removed. Slide 9. Consolidated balance sheet, worked example. This slide provides an example of consolidated statements. Combining parent and subsidiary figures, we aggregate fixed assets, equity, and liabilities. We eliminate intercompany investments, allocate reserves, and compute minority interest. The example shows how to derive consolidated group financial results. Slide 10. Consolidated balance sheet. Solution. This slide shows the consolidated solution. Combined data yields total assets of 100 comprising fixed and current figures. Liabilities are 300. Share capital is 600, reserves 280, and minority interest 60 representing 20% share. Total equity and liabilities equal 100. Slide 11. Consolidated Statement of Profit and Loss. This slide explains consolidated profit and loss preparation. We combine group income and expenses, eliminate intragroup transactions, and allocate profit between parent and minority interests. Key adjustments involve removing unrealized inventory profits and aligning accounting policies and fair value adjustments. Slide 12. Minority Interest Calculation. This slide explains minority interest calculation. Minority interest represents the portion of subsidiary net assets and earnings owned by shareholders. In consolidated statements, it appears within equity as non-controlling interest and reflects the share of subsidiary profit attributable to minorities. Slide 13. Intercompany Transactions Elimination. This slide explains elimination of intercompany transactions during consolidation. It covers intragroup sales, purchases, loans, management fees, and dividends. We eliminate receivables against payables and remove unrealized profits in inventory or fixed assets. Elimination ensures consolidated statements reflect external transactions. Slide 14. Example: eliminating intercompany sales. This slide illustrates elimination of intercompany sales. Parent sells goods costing $80,000 to subsidiary for $100,000. At year-end, 40% of subsidiary inventory remains unsold, creating $8,000 unrealized profit. Consolidation eliminates the $100,000 sales and cost entries and removes the $8,000 profit. Slide 15. Goodwill on consolidation. This slide defines goodwill on consolidation as the excess of purchase consideration over the fair value of net identifiable assets acquired. It undergoes annual impairment testing under IFRS. An impairment loss is recorded if recoverable amount falls below carrying value. Slide 16. Capital reserve on consolidation. This slide explains capital reserve on consolidation, which arises when purchase consideration is less than the fair value of net identifiable assets acquired. Under IFRS, such gains are recognized immediately in profit and loss after reassessing acquired assets and liabilities. Slide 17. Goodwill versus capital reserve, worked example. This slide clearly compares goodwill and capital reserve through examples. In scenario A, paying $250,000 for net assets valued at $220,000 yields $30,000 goodwill. In scenario B, paying $180,000 for net assets valued at $220,000 gives a $40,000 capital reserve. Slide 18. Step acquisition and partial disposal. This slide explains step acquisition and partial disposal. Step acquisition occurs when control is gained through multiple share purchases, triggering remeasurement of held interests and recognition of gains or losses. Partial disposal retains control and is treated as equity transaction. Slide 19. Step acquisition. Numerical example. This slide gives a numerical example of step acquisition. In 2021, Company A acquires an initial 25% stake in Company B for $100,000. In 2022, it purchases an additional 30% for $150,000, raising ownership to 55% and triggering full consolidation. Slide 20. Investment in associates, equity method. This slide explains the equity method for associates. Investments are recognized at cost and adjusted for the investor's share of profits or losses, then reduced by dividends received. The carrying amount appears on the consolidated balance sheet. Slide 21. Equity method, worked example. This slide demonstrates the equity method. Company X acquires a 30% stake in Company Y for $300,000 on January 1, 2023. At year-end, Company Y reports net profit of $200,000 and pays $50,000 dividends, making Company X's carrying amount $335,000. Slide 22. Joint ventures and proportionate consolidation. This slide examines joint ventures and proportionate consolidation. Joint operations grant rights to assets and obligations for liabilities. Joint ventures grant rights to net assets measured under the equity method. Current IFRS standards mandate the equity method, replacing earlier allowance for proportionate consolidation.